Morning, everyone. So what I'm going to do is I'm just going to walk you through a brief overview of how virtual cards have grown within the B2B or the business-to-business payment space and what that means for you. So last year, a research company called CFO Research, they interviewed a number of CFOs from various companies regarding their accounts payable processes. And looking at this study, I pulled two key messages from these interviews. The first is all these CFOs agreed that B2B payments are definitely moving away from paper checks and onto electronic payments. And I imagine most or all of you agree with that, and that's why you're on this call today. So the second message I took from these interviews is that many of these CFOs indicated that their intent to move in the near term from paper check to electronic payments, and they really want to take advantage of the benefits, some of what Miles had mentioned, take advantage of these benefits and really streamline their processes and generate a new revenue stream. So when you look at credit cards, there have been a number of innovations with credit cards. It started with the traditional card, and that's really, when you look at that, that's just your standard plastic card where that's given to a number of employees throughout a company. It's really made to replace petty cash and just make it more convenient. We need to buy miscellaneous items. And what that does is it gives you have control as a company. You have control of this card still, but you're giving it to a number of employees. It typically covers spend up to $2,500. The next evolution of the card is the AP or the Ghost cards, and that's really just an account number. AP cards could be plastic, but you don't need the plastic. Those are really account numbers that will sit either with AP or with a division, and that division can use that account number. That's going to be an account number where you're going to use it when you're making purchases, either online, by phone, or by fax. Typically, these purchases aren't going to be done in person. Then you move into the virtual card. Obviously, that's what we're talking about today. The virtual card is certainly one of the most requested products we have today out there. And this is also known as a single-use account. The virtual card, one of the reasons that it's so attractive is the ease of implementation, but also the controls you get with a virtual card, the security you get with a virtual card. It's a great product. It's helped companies put larger transactions onto a card solution or electronic payment. And when you look at virtual card versus traditional card, the average spend on a traditional card is about $450, where the average spend, or I should say average transaction size on traditional cards is $450. The average transaction size on a virtual card is $4,700. So it's 10 times greater transaction size on the virtual card. So that's something that is definitely helping companies get more spend on electronic payments. The next evolution or next generation of credit cards is what we call straight-through processing. The first three that I mentioned are supplier-initiated payments. That means that the buyer sends over the credit card information to the supplier inputs the account number into their point-of-sale system, then the payment is processed. With straight-through processing, that's a buyer-initiated process. That means the buyer, when they're ready to pay, they'll submit the request into the system, and the money is automatically sent directly into that supplier's bank account. The supplier doesn't have to do anything. They'll get a message saying, you've received a payment in this amount from this person or this company. Now, you're probably thinking this sounds a lot like ACH, and it is very similar to ACH. The two key differences, though, are, one, you can earn a rebate with a straight-through processing, and two, you don't need to exchange or hand out your banking information, which I know is a concern for a number of companies, having to give out all that bank information to multiple customers. So you avoid that, and you get a rebate. So that's something that's still in the early stages, straight-through processing, but I think over the next 12 to 24 months, you're going to see a lot more use with straight-through processing as it gets more mature. So that leads to the question of, have these various card solutions really helped companies move from paper checks to electronic payments? The short answer is yes. And according to a study by Association of Financial Professionals, AFP, they do this study every 3 years. Back in 2004, 81% of B2B payments in the U.S. were done on paper checks. Fast forward to 2013, that number drops to 50%. That's a significant decrease in check payments. And during that same time, card payments for B2B transactions have increased. So some of you may be familiar with RPMG. RPMG is actually the initials for two professors, Richard Palmer and Mohammed Gupta. And these two gentlemen facilitate a purchasing card study every other year. During the off years, they facilitate a study on T&E cards. They've been doing this for well over 10 years, so they've become very well known in the industry. The information that they provide is looked at as being very reliable and very helpful. So this is great information. So the chart that you're looking at now shows how purchasing card volume has grown. When I say purchasing card, that does include the virtual card as well. It shows how the volume has been growing and is expected to grow through 2018 and then beyond. When you look at 2013, $245 million in spend, $245 billion in spend, about 40% of that is virtual card. So virtual card is making up a significant portion of this spend. Now, while it does make up 40% of the spend, virtual card is growing at a significantly faster rate than the traditional purchasing card. So if you look at this chart, what it's showing is in 2018, traditional purchasing card spend is expected to have grown 45% over the 2013 spend, and virtual card is expected to grow 69% over that same period. The 54% is the combined growth rate. But really what I wanted to point out here is just virtual card continues to grow for the reasons that we've mentioned already. So it's something that, again, more companies are looking at, taking advantage of, and getting value from. So why are virtual card payments growing? There are a number of reasons listed on this page. I'm not going to go through all of them. I do want to highlight just a few. The first being, and the biggest reason, is more companies are targeting suppliers that are already accepting cards. That's sort of the low-hanging fruit, just being able to say, hey, you accept card, we'd like to pay you by card. So more companies are doing that. Then the second one is more companies are simply saying, hey, you know what, we want to use a virtual card to make payments. So that's increasing the spend. But the real key point here I want to point out on this page is greater acceptance of virtual card by vendors. This is something that historically vendors have not been quite as open to accepting the card because, as I mentioned, you're getting larger transactions taking place on this card. So vendors have said, hey, we don't want to incur the fees, tied to a card for these larger transactions. The smaller ones, okay, but these larger ones, we prefer a different type of payment. However, that's changing. And really the reason that it's changing is vendors are seeing more benefit, and these benefits that they're seeing outweigh the fees that they would incur. So one of the first benefits that they see is the speed of pay. With a traditional payment method, vendors will typically get paid in about 38 days. With a virtual card, the payment drops to 4 days. That's a huge decrease in payment time. So that's very enticing to the vendor, and that's something that they appreciate and certainly can leverage that. Another reason is the reduced manual labor and paperwork. Again, that works both on the buyer side and the supplier side as well. Reduced bad debt, another great advantage for the vendor. The increased working capital, that really ties into the whole shorter payment cycle. And then the elimination or reduction of buyer side errors. And then the two more points, the next 2 points in my mind are extremely critical for reasons why the vendors are accepting cards. The first is there's research that indicates that buyers are more likely to select suppliers that accept cards. So when you think about going out to, say, a restaurant or a store, you may go to one restaurant or one store over another if they accept card. So that's a good reason for vendors to accept cards. The second reason, sorry about that, advancing too quickly. The second reason is card acceptance has been shown to promote loyalty and stickiness with customers. So again, these are two really big reasons why vendors are accepting cards. And quite frankly, card acceptance is almost becoming table stakes, where if you want to compete in your line of business, you need to accept card because more customers are demanding card acceptance and more vendors are offering card acceptance. So if you really want to be competitive, you now have to accept card. And on the right here, you can see there are two quotes here. The first one talks really about getting paid more quickly and being able to leverage the working capital. The second one talks about reducing labor and also reducing errors. This illustrates, the value of the card, as we mentioned here. So what does this mean for you? Again, some of these we've already talked about, but eliminating manual processes, reducing costs associated with paying by a check, easier tracking and reconciliation. Since all of these payments are electronic, makes it very easy to track and reconcile. So now you don't have to sit at your desk and wonder, gee, when is the mail going to deliver that check? It can be followed all the way through the process because it is all electronic. And then, as Miles had mentioned, you can earn a rebate on your spend. So this is something where a number of companies are looking at it and think it's a great opportunity, not just to streamline processes, but to earn that rebate. So if we look back at 2008 and 2009 when the recession was really starting to hit a number of companies, we had many companies reaching out to us proactively and saying, listen, we need to continue spending to keep our business going, but we need help in streamlining those processes and potentially generating some type of revenue stream. So that's where the virtual card came into play. Companies implemented that, and again, going back to what Miles said, it was easy to implement, so it's something they could do quickly, and they realized the benefits of the card. They got a rebate, and this is something that continues through today, where more and more companies are leveraging this.